a 219-page collection of investment letters. These are the Nomad Investment Partnership letters written by Nick Sleep and Zachariah from 2001 to 2014. And I'm going to tell you something that's going to sound insane. They compounded capital at over 20% per year for 13 years. And the secret wasn't finding hidden stocks or complex trading strategies. The secret was doing almost nothing. There's a line that appears in these letters that I think explains their entire philosophy. Nick Sleep writes, Charlie Munger is right when he says, it's just that simple. We make our money sitting on our assets. Let me read that again because it's so important. We make our money sitting on our asset. This goes against everything the investment industry teaches. The entire financial services complex is built on activity, trading, quarterly reports, monthly updates, constant communication. And Nick and Zach looked at this and said, that's completely backwards. And for those who don't know, and the reason why I'm doing this is because it helps me retain information. I'm building the Nomad Capital, similar strategies to the Nomad Fund that Nick Sleep created. And the focus will be on the AI infrastructure. But I'm not here to promote my fund. So let's get back to it. So here's the crazy part. Okay. In their first letter from 2002, they tell their investors Nomad's orientation is genuinely long-term, and more regular reports, daily, weekly, monthly, or otherwise, are likely to be of little value to you and may even be counterproductive for us. Think about that. From day one, they're telling their investors, we're going to talk to you that much because talking to you might make us dumber. This is exactly what Warren Buffett did with the Buffett partnership. Exactly what Walter Schloss did. When Walter was interviewed, he said he didn't even tell his clients what stocks he owned because one time he did, the client got nervous and withdrew his money right before those stocks went up. Walter learned silence is a competitive advantage. Now, Nick Sleep discovers something that explains Amazon, Costco, Berkshire, and every great business in the Nomad portfolio. He calls it scale economics shared. And here's how it works. Most companies get more efficient as they grow, right? They get economies of scale, lower costs. But what do they do with those savings? They keep them, they expand their margins, they make their shareholders happy in the short term. Nick found a handful of companies that did something radical. They gave those savings back to the customers in the form of lower prices. And this is where it gets beautiful. When you lower prices, customers buy more. When they buy more, you get even more scale economies, which lets you lower prices more, which makes customers buy even more. Do you see the cycle now? It's a flywheel. And the companies that do this, Amazon, Costco, AirAsia, builds moats that gets wider as they get bigger. Listen to what Nick writes about Costco. Management described the strategy as easy to understand and hard to operate. They could mark up goods and break the contract with the customer, but they don't. He finds this memo from 1967 by Sol Price. The founder of Costco predecessor company, FedMart, I have it framed in my office and it says, although we are all interested in margin, it must never be done at the expense of our philosophy. Margin must be obtained by better buying, emphasis on selling the kind of goods we want to sell, operating efficiencies, lower markdowns, greater turnover. Increasing the retail prices and justifying it on the basis that we are still competitive could lead to a rude awakening. Let us concentrate on how cheap we can bring these things to the people rather than how much the traffic will bear. And when the race is over, FedMart will be there. Now, Nick writes, 43 years later, almost to the day, and Costco is the most valuable retailer of its type in the world. This is Henry Ford's playbook from 1908. Nick includes an actual chart from the 1927 report showing how Ford dropped the price of a Model T from 950 to 300, while production went from 0 to 2 million cars per year. Same model, same principles. It worked in 1908. It worked in 1967. It works today. Now, most investors think that their job is to find undervalued stocks, buy them, wait for them to hit the fair value, and sell. Nick completely rejected this. Okay, he said, our aim is to make investments at prices we could consider to be 50 cents on a dollar. Capital allocation by these investee companies must be consistent with the value creation, and if this is the case, we expect the real value of the business could grow at around 10% per annum. So he's buying dollar bills for 50 cents. But here's the thing. If he's right about the business, the dollar grows to 162 over 5 years. So his 50-cent investment becomes worth $1.62, and that's 26% annual returns. But then he said something that's most investor misses. And if over 5 years our mistakes are on aggregate flat and our mistakes total half of partnership assets, then this implies a compound annual return of 13% for the portfolio as a whole. He's building in a 50% error rate and still expecting 13% returns. That's conservative, positioning sizing combined with extreme patience on winners. Now, Nick includes this insane chart in one of his letters. It shows Walmart's stock price from 1972 to 2010 in blue. And then in red, it shows the price you could have paid at any point in Walmart's history and still earn 10% annual returns through 2010. Here's what the chart reveals in 1972. You could have paid 150 times the actual stock price and still made 10% that year. Or, let me correct that, 10% per year. There's a big difference. 10 years later, in 1982, you could have paid 200 times earnings, a price the market would call insane, and still done fine. Why? Because the market completely underestimated how long Walmart's competitive advantage would last. Nick writes, investors see the information but incorrectly weigh the information. Investors recognize success incrementally when the factors that lead to success, such as scale, economic share, may be constant. This is the key insight. The market assumes regression to the mean starts immediately. But for companies with true moats, regression to the mean might not happen for 30 or 40 years. Now, Nick is ruthless about why most investors fail. He writes about a large fund management company that sold IBM in the 1970s. 30 years later, that stake would have been larger than the entire asset under management. So they learned their lesson, right? Wrong. At the same time they're analyzing their IBM stake, they also sell Walmart. 30 years later, that Walmart stake would have been larger than the entire firm. How is this possible? Nick gives you the list. Pay attention to this. Number one, misanalysis using the wrong mental model. Investors think every company has one good product, then struggles. They miss that Walmart's advantage was structural, not product based. Number two, structural problems. Fund managers have to look active. If you hold the same stocks for 10 years, clients think you're not working. So managers sell winners to buy something new just to have a new story to tell. And number three, incorrect probability weighing. Investors default to thinking good things don't last. And on average, they're right. But the whole game is finding the exceptions. Now, Nick writes the average holding period for stocks is down to 10 months, and the average mutual fund is held for 2 years. What's that all about? He continues, institutional money managers appear to reason. Why take a stand today when the shares could be half this price if I wait? In taking such a timid view, they sell their investments, themselves and their fellow shareholder, down the river. This is savagery. He's saying the entire professional investment industry is built on cowardice. Here's where Nick Sleep shows how he thinks different than everyone else. And most investors worry about stock price volatility. Nick writes, Zach and I see our job as controlling the risk of misanalysis of the big things. Value per share of an investment many years out, not spotting wiggles on the path along the way. Everyone else does wiggle guessing. The real risk isn't the stock price going down next quarter. The real risk is selling Amazon in 2005 because you think it's fully valued. He tells the story about MBIA, a bond insurer. They made an investment, then realized there was a massive dilution risk. The company might issue tons of new shares at low prices, which would destroy their returns, so they sold. Nick writes, although we have a profit on our investment in MBIA, shareholders should be careful what they wish for. Before congratulations are in order, patterns need to weigh in their short-term profits against value foregone. He's saying, we made money, but the real question is, what did we miss by selling? This is exactly what Warren Buffett means when he says his biggest mistakes were errors of omission, not commission. Now, Nick's analysis of Amazon is a masterclass. He writes, Amazon reported free cash flow of just over $500 million. What's important is that the $500 million is after all investment spending on growth initiatives such as capital spending, but also research and development, shipping subsidy, marketing and advertising, and price givebacks. Then he does something brilliant. He estimates that the discretionary growth spending is another $500 million. So if Bezos wanted to, he could stop all the growth investment and return $800 million per year to shareholders. At the stock price when Nick was buying, the market was valuing Amazon as if all that growth spending was worthless. The market was literally saying, Jeff, just become a cash cow and stop trying to grow. Nick writes, This is an odd statement to make for a business growing revenues in excess of 20% per annum. Then he quotes Bezos from the annual report. As our shareholders know, we have made a decision to continuously and significantly lower prices for customers year after year as our efficiency and scale make it possible. However, our quantitative understanding of elasticity is short term. We can estimate what a price reduction will do this week and this quarter, but we cannot numerically estimate the effect that consistently lowering prices will have on our business over 5 years or 10 years. Our judgment is that relentlessly returning efficiency improvements to customers in the form of lower prices creates a virtuous cycle that leads over the long term to a much larger dollar amount of free cash flow. Nick adds, as our shareholders know, judging by the share volumes, they don't. This is the disconnect. Bezos is executing a 10-year strategy. The market is valuing a 2-quarter outlook. Now, he talks about the psychology of patience. And one section, Nick writes extensively about why patience is so hard. He cites research and showing the brain has 2 systems: the limbic system, survival, immediate rewards, and the frontal parietal system, analytical, long-term thinking. When you're stressed about money, the limbic system overrides the analytical system. You start valuing a meal today over a feast next week, even when the last feast is more valuable. Nick writes, so the more stressed we are, the more we value short-term outcomes. This is not without reason. For if starving is a real possibility, a meal today is more important than a feast in a week's time. But investing, this is death. He says, at Nomad, we try to be more analytical. It is the 2 birds in the bush we are concerned with and how they compare to the bird in the hand. He tells investors over and over, focus on the price to value, not performance. You should be more pleased with the improvement in the price to value ratio of the partnership than the gain in the price of the partnership this year. That's easy to say when the results have been reasonable, but it would feel quite different if the partnership had declined in price instead. And then it happened. In 2008, Nomad was down 45%. Did investors panic? No, because Nick had trained them to think about business value, not stock prices. He writes after the crash, it may not feel like it, but for long-term investors, this is the best of times, not the worst. It is the environment that people sell their GTOs for 750 pounds. GTO reference is to a Ferrari 250 GTO than someone who bought for 750 in the 1960s. That's now worth tens of millions. So here's a fee. This is important. Okay, the fee structure. Most hedge funds charge 2% management fee and 20% fee every year. Nick thought this was insane. He writes, philosophically, our position is that the management fee should not be a profit center. We would therefore propose a new management fee that will reimburse the operating company for its costs incurred in running the operation. So Nomad charges actual costs. As the fund grew, the management fee declined as a percentage. So it went from 50 basis points to under 10 basis points. But here's the really radical part, the performance fee. Most funds have a high water mark. If the fund goes down, the manager doesn't get paid until it recovers. But after it recovers, the manager gets 20% of everything above the old high. Now, Nick said that's not fair. So Nomad had a refundable performance fee. If they did well, fees went into a reserve. If they did poorly, money came out of the reserve and went back to investors. Nick writes, this places the performance fees you pay into the reserve at risk of refund for subsequent poor performance for an average 5 years, and this aligns the duration of our rewards with yours. And in 2008, when the fund was down, investors literally got paid by Nomad. Performance fees that had been accrued were refunded. Show me another hedge fund that does this. I'll wait. Now, for the partnership structure, Nick refuses to call Nomad a fund. He insisted on calling it a partnership. And he meant it. When investors wanted to know what stocks he owned, he sent them full portfolio, but asked them to not share it. Not because of regulation, but because if you share your ideas, you're hurting your own returns. He writes, investors will understand that the further distribution of our ideas is contrary to all partners' interests. When the fund needed to grow, Nick didn't do a marketing roadshow. He opened subscription, messaged to the new investment ideas, and closed when the ideas ran out. He writes, capital should only be raised in the response to investment opportunity sets. Most funds do the opposite, raise money, then figure out where to put it. And in the 2008 crisis, Nick opened the fund. Barely anyone subscribed. In 2012, when the market had recovered, he opened again. This time, subscriptions poured in and he had to close within 2 weeks. Nick writes, I had the experience in mind when we decided to reopen in the new year. But this time, demand was such that within 2 weeks, we had to close again. Quite a contrast. But he doesn't celebrate the new money. He's not trying to maximize assets under management. He writes, we do not like being open, and we are happy with our hermit-like state, minding our own business and getting the job done. Now, the end game is into 2014, Nick and Zach closed the fund. They were in their mid-40s. They've compounded money at 20% per year for 13 years. They turned $1 into over $10 after fees, and they just stopped. Why? Nick explains it in the preamble they wrote in 2021 when releasing these letters. We wound up at an age mid-40s when it forced us to build something new. You can't sit on the beach forever, and hopefully we would live long enough to see the consequences of our actions. We would have to eat our own cooking, as it were. They shifted to philanthropy, but the core insight is this. They didn't need more money. They had what Charlie Munger calls enough. And Nick writes about the X amount concept. Once past X amount, real meaning comes with reinvesting in society through charitable living, which can also be thoughtful, challenging, wonderful adventure, but with added bonus that it feels like the world working properly. Here's the lesson. Here's what I kept coming back to these letters. Nick Sleep figured out the investment industry is solving the wrong problem. Everyone is trying to predict the next quarter, the next earning report, the next macro event. They're optimizing for being right in the short term. Now, Nick optimized for being right about 5 things. 1, business model. Does this company have a scale economics shared? Number 2, management. Is this a founder who thinks in decades? 3, valuation. Are we paying 50 cents on the dollar? Number 4, time horizon. Can we hold this for 10 years? And 5, position sizing. If we're wrong, will it matter? If we're right, will it matter? And that's it. That's the whole game. Everything else, the macroeconomics, the quarterly reports, the news flows, it's noise. Nick quotes Charles Darwin in one letter. Darwin spent 4 years traveling the world collecting specimens. Then he spent the rest of his life thinking about what he'd collected. Now, Nick writes, perhaps the greatest naturalist that ever lived and had more effect on our thinking than anybody, Charles Darwin, only spent 4 years traveling and the rest of the time thinking. That's the model. Do research. Find the exceptional companies, then sit on your ass. And in their last letter, Nick writes something that I think summarizes everything. It appears to all the world that the performance has been created by Zach and me. That is not the case. In aggregate, the fund management function does not add value per it only shuffles wealth created elsewhere. The performance that you receive as partners in Nomad is the capitalization of the success of the firms in which we have invested. The wealth you receive came from the relationship our company's employees have with their customers. If this relationship that is the source of aggregate wealth created in capitalism, and this is a profound humility, Nick is saying, we didn't create wealth. We just found companies that were creating wealth and stayed out of their way. But here's the thing. Finding those companies and staying out of their way is incredibly hard. It requires you to ignore your peers, ignore the media, ignore your own desire for action, and just wait. And remember, Nick said that we make our money sitting on our assets. In 13 years, they turned $1 into over $10. And the secret was doing almost nothing. If you're building a company, if you're investing, if you're trying to build something that lasts, the lesson from Nick's sleep is this. Find the right thing, then be patient enough to let it work. And that's it. That's the whole game. And almost nobody can do it.